The unemployment rate is at the highest level since the Great Depression. Businesses are closing down at rates that we have never seen in history, and the world economy has seemingly hit its biggest roadblock since the Great Depression. But there have been some strange things that have been going on during all of this turmoil. For example, real estate prices have actually stayed the same or even gone up for most areas in the United States. Another thing is that the number of bankruptcies in most countries have actually decreased over the last few months. And of course, the stock market has actually risen by over 30% since March 23rd. So how can all of this be possible? In a time when most economic indicators are showing that we are going through the worst economy in nearly a century, we are also seeing a relatively healthy stock market and real estate market. Well, some of the reasons why this is happening might be a lot scarier than you think. The first thing that may have partially mitigated a worldwide collapse is the debt that governments around the world have been taking out and giving to its citizens. In fact, governments have taken out nearly $16 trillion of debt in the last few months alone. And just some perspective for you is that an average year we'll see about $7 trillion worth of debt being taken out worldwide by governments, meaning that the world is compiling debt at a rate that is 10 times higher than normal. Now that means two things. The first of which is that this debt will provide a temporary stimulus for the economy that will likely last for several months to upwards of about a year. But the second thing that will come from this debt is much more negative. You see, at some point, governments will have to pay back this debt, and this will come in the form of tax revenue, meaning that a large portion of tax revenues for the next several decades will likely go towards paying back this 3-month period in time where debt was compiled at extremely high levels. But debt is not just being taken out by governments, it's also being taken out by businesses and individuals. Household debt in the United States is now at a record high of $14.6 trillion. In fact, a recent report showed that in early March, nearly 43% of adults in the United States had some sort of credit card debt. But now that number has jumped to a whopping 47%, which is one of the largest spikes in history. And also, 23% of credit card debtors surveyed by creditcards.com said that their credit card debt is a direct result of the pandemic. And the survey also found that millennials have been hit the hardest, where 34% of millennials had to go into further credit card debt because of the pandemic. So what this means is that debt seems to be arguably the biggest factor as to why markets around the world have not collapsed so far. And for now, this debt has provided some relief and helped prevent a much worse downturn in some areas like the stock market and real estate. But this debt burden will likely hurt the global economy for years to come, or potentially even decades. Now, another thing that has been happening is that central banks have been printing money at rates that we have never seen before. Pretty much what central banks like the Federal Reserve have been doing is that they've increased the money supply within the economy. The way that they do this is a little bit complicated, but to summarize, essentially $3.5 trillion has been added to the economy to help deal with debt, give out loans to businesses, and give cash reserves to the big banks. Now, the economist Tim Dye said that if these measures were not taken by the central banks in the last few months, the system already would have blown up and markets would have crashed 10 times over. Now, what does this all have to do with the stock market? Well, first of all, sometimes crashes take time. In September of 2008, it felt like the entire global economy crashed within the span of 2 weeks. But in reality, it took 517 days to reach the bottom of the financial crisis. And during that time, there were many weeks or even months where the markets performed fairly well. So it is possible that the recession that we are going through today might reach its worst point in well over a year, especially if the debt market collapses or if the economic recovery is slower than people think. Now, another reason why the stock market has not collapsed is that many of the largest public companies in the world have actually benefited and performed very well during the last several months. Amazon, for example, which is the third largest public company in the world, actually saw a 17% growth in revenue in the last quarter. Apple saw a 4% increase in earnings, Microsoft saw a record amount of earnings and revenue in the last quarter, and Facebook and Google had similar results with increased revenues. And what's interesting is that those 5 companies compose nearly 20% of the S&P 500's value, meaning that 20% of what most people view as the driver of the stock market is really only tied up in 5 companies, all of which have performed well during the pandemic. But even if these public companies or many of the other public companies in the United States perform well, that doesn't mean that the vast majority of businesses will perform well too. You see, this pandemic has hit small businesses the hardest, and there are 23 million privately owned small businesses in the United States. Meanwhile, there are only 2,800 businesses publicly listed on the New York Stock Exchange, meaning that the stock market only represents a small fraction of what is really going on in the business world. But arguably the most haunting thing that most people do not know about the stock market is this. You see, people think of the stock market as millions of investors and day traders each making trades every day in order to try and grow their portfolio. But in reality, only about a dozen investment groups determine the vast majority of the activity that occurs within the stock market. Some of these groups are Spider Funds, BlackRock, Vanguard, UBS, Bridgewater, J.P.Morgan, Goldman Sachs, BofA Securities, and Morgan Stanley. Each one of these institutions manages between $500 billion worth of assets, like Morgan Stanley, and nearly $7.4 trillion worth of assets, like BlackRock. Let me say that again. BlackRock manages $7.4 trillion worth of assets. Let's put that into perspective. The average adult has around $50,000 invested in the stock market either directly by themselves or indirectly through things like retirement accounts. This means that a company like BlackRock has as much say in the stock market as 148 million average adults. My point I'm trying to make here is that the prices in the stock market might be more correlated with the assets under management and investments of the largest institutions in the world rather than the economy itself. Now, after saying that, these companies are all competing with each other, and most of their assets come from average people letting companies like BlackRock invest their money for them. For example, I have both bought and sold shares from funds of a handful of the largest investment firms in the world, and if you have a retirement account or have bought an ETF, then you have probably done the same too. But still, at the end of the day, really only about a dozen institutions make the vast majority of the investment decisions within the stock market. So theoretically, as long as a few executives at each one of these companies are bullish on the future of the stock market, that might just be enough to single-handedly keep the stock market afloat, even if the public were to be bearish on the stock market. So all in all, what we have learned over the last few months is this. The stock market is not as tied to the economy as most people think. About a dozen institutions have disproportionate control over the stock market. Also, just because large companies are performing well, that does not mean that millions of small to medium-sized companies are performing well too. And lastly, the debt that the federal government and central banks are compiling is arguably the largest reason why we have not seen a global meltdown as of yet. But who knows? Based on previous history, this hit to the economy that we are currently experiencing will likely be felt for years or even decades to come. But maybe not. I mean, as I've mentioned before, this was the sharpest decline of an economy in the history of human civilization. But that also might mean that we could potentially see the fastest recovery in the history of human civilization as well. So what do you think is going to happen? Do you think that the economy and the stock market are in for some tough times ahead? Or do you think that things will get better as places begin to reopen? Let me know in the comments down below. Also, please hit that like and subscribe button, that does help me out a ton. And I'd just like to mention that as I'm currently recovering from a heart condition, I'm aiming to get back to posting 2 videos a week again, and hopefully some of them will be on more topical events just like this. And also make sure to click on my documentaries playlist to check out more videos just like this, so make sure to click on that, and I will see you guys in my next video in just a few seconds.